have what's called deferral, where active earnings overseas aren't taxed until they're repatriated back to the U.S. So if you are earning active income, like from running business, making sales, and things like that, and you leave it overseas, the U.S. won't tax it until you bring it back. They will tax more passive types of income, like interest and dividends currently, but you can leave your active income overseas and avoid that U.S. tax. And so with that high tax rate and that ability to defer the U.S. tax, then you create this incentive to leave earnings overseas. And politicians and policymakers on both sides, liberal and conservative, see that if we can incentivize firms to bring those earnings back, then one, we can tax them, two, the economy will grow, which then will create more tax revenue. So that's really the combination of things that we're seeing both sides wanting tax reform.
Yeah, those are great comments. I think to add to that, so if you have a really high U.S. tax rate and you have lower tax rates in most other developed nations, what that does is that provides incentive to U.S. companies to source their business operations in those foreign jurisdictions and pay less tax. And so because of that, this high rate of U.S. tax is actually negatively impacting U.S. business. And so it has the effect of moving jobs overseas. That's certainly not what we want. And in addition, you're trapping that cash over there. You want to bring that cash back into the U.S. economy, because more cash in the U.S. economy provides more liquidity, and our economy starts working better. So there's some real strong incentives to try and reduce this corporate tax rate. And as John said, there's a lot of incentive on both sides of the aisle to reduce this rate. It's not just a Republican thing. It's not just a Democratic thing. I think it's a congressional thing that people are focused on reducing that corporate rate. The other thing, the other impact it has is that we're not getting as much foreign investment in the U.S. And so if a large foreign company is trying to figure out where do we establish a major headquarters for our business, they're going to weigh many different factors, workforce and availability of supplies, that sort of thing. But taxes is also a significant consideration. And so if we've got a very high corporate tax rate, again, we're chasing off business that could be here in the U.S.
Yeah, I mean, to me, it presents some interesting questions. The current system, you have this incentive to leave this money overseas, and I mean, the whole reason to run a business, right, is to eventually, you make money and then you bring it back and pay it out to your shareholders as a dividend or in the form of stock repurchases. But for these overseas earnings, these companies can't do that unless they pay the additional U.S. taxes on the earnings. And so, from a research perspective, what I found interesting is, well, how does that affect their decision making when they make investments abroad? And we had a paper that I wrote. We looked at that a little bit and compared acquisitions that U.S. companies made abroad and the market response to that and the earnings performance subsequent to the acquisition to acquisitions they were making domestically. And of course, the acquisitions they were making abroad, we tried to infer whether that was made with this trapped earnings or trapped cash. And the performance of those investments was much lower, right? Because sort of the hurdle rate or the cost of capital for those is really lower because you have this tax overhang. So we have a very unusual tax system that's kind of affecting the way firms behave. It's providing this incentive to leave the money overseas, and it might be causing them to make investments that they wouldn't otherwise make. The analogy I make is like for the college students out there, when you have cash in your pocket, you tend to make bad choices on Friday night. Well, the company's got a lot of cash sitting around, they can't bring it back, they don't have the discipline of paying it out to shareholders. That can potentially create problems as well. So,
one other comment I hear a lot from my clients, and I think we hear a lot in the news too, is our tax system is so complicated, and there's a lot of perceived, anyway, a lot of benefits for special interests out there. And so I think there's a lot of folks who would like to limit the complexity in our tax system. They'd like to simplify, and they'd like to get rid of a lot of the special interests that are getting tax benefits that your average everyday company isn't getting.
Okay, well that's a great kickoff to the evening, a little background. So the next question I want to ask is for Ryan Wilson, Professor Wilson. The U.S. has one of, if not the highest corporate tax rates in the world. Does this mean that U.S. companies face a greater tax burden than their peers from other countries?
Yeah, that's a complicated question, and I don't, it's hard to provide.
That's why I asked the experts.
And I'm an academic, so I'm just going to obfuscate answering that in a way. But I did some research, right? There's been a handful of papers. This is a really interesting question. So there's been a handful of papers in econ and finance and accounting that have looked at this. If you just look at the statutory rates, it's true, the U.S. rate is about 14 points higher than the other OECD countries in the world, so the other big developed countries in the world. There was a paper by Markle and Shackelford that was published in 2012 that looked at the tax burden, the actual effective rates of multinational corporations across 82 different countries. And they found that the firms located in Japan, the US, France, and Germany had the highest tax rates, which I thought was kind of interesting. I mean, those are also some of the most developed countries. They have some of the most highly educated workforces, so that may explain the ability of those countries to sort of charge these high tax rates. They found that it varies a lot by industry, a tremendous amount. If you're in the retail industry, the tax rates tend to be really high. Your opportunities to avoid taxes are limited. If you look at a company like a mining companies, they pay very little in income taxes. So you can have countries like Canada that have relatively high tax rates, but if you look at their companies, because 24% of the companies in the country are mining companies, those companies have very low tax rates. So a lot of it depends on the industry composition of the country that you're looking at. It has more to do, I think, with the industry than the country, if that makes sense. Also, it's interesting in this study, they show that the tax rates all over the world have been going down over time. Over the last 20 years, they've gone down a lot, corporate tax rates. But what's interesting is the ordinal ranking of the countries has not changed hardly at all, which I thought was fascinating. And I think that ordinal ranking has a lot to do with the ability of those countries to tax. The other thing to keep in mind is you have countries like the UK that have lowered taxes a lot, income taxes on corporations, but they've increased carbon taxes and sort of other taxes. In the US, we offer a lot of tax benefits to corporations. So it's a little bit of a kind of a trade-off. So it's not really an easy question to answer, but it does look like we have relatively high tax rates in the U.S. So.
Anybody want to add anything to?
Well, I think, just on the face of it, we've got a very high tax rate. I think, businesses, everybody's concerned about that. And I think just from a perception perspective, it would be very helpful for our business economy to figure out how to get it reduced.
Yeah, I can add, so if you want to compare tax systems, you can look at the tax rate, but it's also important to look at the tax base. So some countries might allow more deductions than others. So the tax base is how much of that income that you're going to tax, and that's driven a lot by how many deductions that country allows. And since Ryan brought up some research, I'll bring up another paper by Dyring, Hanlon, and Thornock that's kind of looking at the trends in U.S. tax rates, or U.S. corporate tax rates over time. And they find actually that purely domestic firms don't have higher tax rates than multinational firms. So the U.S., even though we have that high tax rate, does have significant deductions that firms can use within the U.S. One of those is something called bonus depreciation, which used to be enacted just when we started going into bad economic times, but I think it's more permanent now. And that allows firms to deduct half the cost of capital expenditures in the year that they buy them. And you can see in their graphs that the tax rates dip every time bonus depreciation is enacted. So looking at that tax base, so what kind of deductions are allowed, is important, as well as looking at the tax rate.
So now, it was in the news recently that Apple had been able to pay very little in taxes, and then we heard news from the EU, and I was hoping we could learn something about the situation. So this question's for Linda. How have companies like Apple been able to pay very low amounts of tax on income from foreign subsidiaries?
Well, they use a combination of different things. One is that they want to take deductions in high tax rate countries and recognize income in low tax rate countries. Two, they use kind of nuances in the US tax laws. Three, they use discrepancies in how, for example, one country will define what an entity is versus another country, and then they also use treaties between countries. So they create kind of, a lot of times, complex structures that allow them to avoid taxes, combining all these things. Apple, in particular, they use a nuance or a particularity of the Ireland tax law, which taxes a country or a company according to where its headquarters are, whereas most countries will tax a company according to where it's registered. So they will register a company in Ireland, but then put its headquarters somewhere else, like the US or Bermuda, and so no countries deem that as a tax resident in their country, so the income can escape taxation. A lot of companies will also create more complex structures that use, for example, that nuance, as well as payments between subsidiaries, so royalty payments between subsidiaries, sort of inflating the royalty that would be paid in the higher tax country to the entity that's not considered a tax resident anywhere. And so you have a US parent with this Irish subsidiary that's actually got its headquarters somewhere else, so it avoids tax. And then another Irish subsidiary that's going to sell the goods and has the income, but then it pays a royalty to the entity that doesn't have a tax residence anywhere. So that Irish company's income nets out, and then the royalties are paid to a company that no countries are taxing. The U.S. would tax that royalty payment because it's passive income under Subpart F, but they use another nuance under U.S. tax laws that says you can check the box to decide if a company is going to be a corporation or a flow-through entity. And if you check the box and say it's a flow-through entity, then the U.S. ignores that payment between those two subsidiaries. So you escape the tax in Ireland, and you escape the tax in the U.S. That's called a double Irish, which is you can also put a Dutch sub in there to avoid foreign withholding taxes, and they call that Dutch sandwich. But that tax strategy is going to be a lot harder because Ireland was pressured to change its rules that allowed those companies to not have a tax residence. So those are some of the different types of things firms can use, but maybe Dave or Brian can describe some
I'd be happy
others.
to provide some comments on that. So what multinationals do a lot is to figure out, okay, we've got intangible property. Intangible property is valuable. And so if we have this intangible property in the U.S. and we're getting revenue in the U.S., that revenue in the U.S. is going to be taxed at the U.S. rate. That's a pretty high rate. If we're selling product outside of the U.S., do we have to bring those profits back to the U.S. right away and pay those taxes, or can we, potentially keep the profits offshore and only pay taxes when we bring them back to the U.S.? So what a multinational will oftentimes try to do is move some of that activity or that IP to a jurisdiction that has a lower tax rate. And they do that through transfer pricing, and there's what we call a buy-in payment, where the U.S. entity will sell this IP to their foreign subsidiary for a buy-in payment, and then that foreign subsidiary then owns that intangible property. So if there are products being made and sold throughout the world that are not being sold in the U.S., and this foreign entity will own the rights to the intangible property that relates to those products, so those profits will end up in that jurisdiction with the low tax rate. And so at the end of the day, it all makes economic sense. If this entity in the foreign jurisdiction bought the intangible property for the right price from the U.S., and there's been a lot of litigation with the IRS trying to make sure the price is correct, and there's a ton of regulation out there, the transfer pricing rule, Section 482, to make sure that these prices that are being charged between these entities are appropriate in their arm's length. And so when you have this profit being generated by that entity in the foreign jurisdiction, they're paying a very low rate of tax. So then the magic comes in these scenarios, in these situations like where you have a double Irish. So when you have this IP in a foreign jurisdiction, and you can set it up in a way that the profits that relate to the IP are taxed in what we call a stateless entity, an entity that doesn't have residence in any particular jurisdiction, there's really nobody taxing those profits in that foreign location. And so, a lot of people get concerned about that. A lot of people say, well, shouldn't somebody be taxing that profit? Well, that entity actually bought that property to begin with, and so the right amount of profit is ending up in that jurisdiction, which is zero or a low rate of tax, but that isn't being taxed anywhere else around in the world until that profit comes back to the U.S. And so, a lot of companies think, or a lot of countries, a lot of tax authorities think that's kind of gaming the system, and so there's been a lot of concern over that type of structure, that these profits are not coming back to the U.S. or being taxed in Ireland. And we'll talk about that in a moment. But yeah, these structures have been, are very commonplace with multinational entities. And it all comes down really to this concept of transfer pricing, making sure the right amount of profit is ending up in the right jurisdiction based on what the assets and the activities are in that jurisdiction. And so economically, it all makes sense. But economics are kind of falling by the wayside, as we'll talk about in a little bit, with respect to how tax authorities are approaching these types of structures.
So there'll be a quiz at the end on a double Irish and a Dutch sandwich, and exactly how you pull that off. So, no, as you can see, they spend a lot of time figuring out how these things work. Next question is for Ryan, and it's again related to Apple. Apple was recently assessed $14.5 billion in back taxes to Ireland by the EU. What is the basis for this decision by the EU, and what is the cause of the dispute? And what are the implications for regulators in the U.S.?
Yeah, it's a really interesting case. So this happened pretty recently. This was so this is the European Union that is assessing this $14.5 billion on Apple. This was their competition enforcer, I guess, that came up with this. Their concern, or the allegation from the European Union against Apple, was that Ireland was basically providing Apple with state aid, with government subsidies. And that goes against some of the agreements that were made in the European Union. With the whole European Union, this whole concept, right, is they want to have a level playing field, right, like one integrated economy. So they don't want these different countries competing against each other to attract businesses to their country by providing these subsidies. And so they're alleging that Ireland was providing a subsidy to Apple. Apple had reached several tax agreements with the Irish government. I think the first one was in '97, and they had some subsequent agreements. They were using this double Irish strategy that Linda articulated, that, and I won't go through again, but I mean, at the center of this was this Apple Sales International, which was one of these entities in this double Irish transaction. That was the entity with the intellectual property. So most of the profits for their worldwide sales outside of the US were being sourced to this entity. I think they said in one of the years it was roughly $16 billion in profits. That was 2012. And overall, they allocated about 50 million euros of the profits, so 50 million of the 16 billion in profits, to Ireland. So Ireland was imposing a very small tax on that. The rest of it was in this these corporate headquarters or this stateless entity, so it wasn't assessed tax. This is what the European Union had a problem with. They want Ireland to go back and assess taxes on Apple. It's interesting that the Irish government doesn't want to do that, right? Because they're afraid of losing Apple, having them depart. I mean, the main reason they're probably operating out of Ireland is for this tax benefit. There's currently 6,000 employees in Ireland working for Apple, which is a big deal, and they don't want to lose that relationship with the company, and it's a big deal for the U.S., right? Because Linda kind of talked about, we have this worldwide tax system with this deferral. So eventually, if you think this stateless income or this $16 billion in profits that's not being sourced to a foreign country is eventually going to be repatriated back to the United States, eventually you would have to pay U.S. taxes on that money. And so now, if Ireland has to go back and assess these taxes, Apple's going to get a foreign tax credit for that if they ever do end up paying it, and I'm sure this will be litigated for a long time, but if they do end up paying that, they'll get a foreign tax credit, and the U.S. government is going to be out that tax revenue. So it's Ireland that would gain from that, although they may lose business relationship, and then the U.S. is going to be the loser in that relationship. So you know, it's a complex transaction. I think it's just a situation where businesses have evolved and intellectual property has become so important to these businesses, and income is mobile now, and the tax laws in these countries are just not keeping up with that evolution. So it's interesting.
Yeah, I think it's going to be an interesting case to follow through the system. You know, one of the main arguments against it is you can't go back and legislate taxes and you know, regimes that were in place and that companies set up structures around and, you know, built entire businesses in countries. And to go back and then, you know, after the fact to say, nah, we disagree, you know, that you're giving an unfair advantage to that company to operate in that jurisdiction. You know, that 20/20 hindsight it's not good business. And so I think it'll be interesting to see how this actually works out in the court system. You know, it's also going to be interesting to see how Apple deals with it, you know, with the financial statements, because, you know, this has significant implications to them. You know, with financials, typically you'll show what your effective tax rate is. And if you are a multinational that has operations in a foreign jurisdiction, you don't necessarily show, because eventually those profits, you know, are going to come back to the U.S. or they're expected to come back to the U.S. unless the company can show that, no, we've got plans for this cash offshore and we're not going to bring it back to the U.S. And so your financial statement will just show the foreign tax effect. It's not going to show the U.S. tax effect, the 35% when that cash comes back. Well, now, if Apple is paying these additional taxes in that foreign jurisdiction, you know, those taxes are going to go directly to the financial statement, even though they're going to eventually get a U.S. tax credit for it. So is Apple going to show, you know, this tax credit in the return? Are they going to, you know, just show the $14 million, you know, expense in the foreign jurisdiction? So there's a lot of hair on this. So it's going to be an interesting situation to see how it pans out.
Yeah, absolutely.
So the next question is for Dave. Given that corporate tax avoidance appears to be a thorn in the side of other countries, what steps, if any, have international organizations like the OECD taken to address the issue? So
Yeah.
follow on to.
All right, so I'm not sure if anybody in the room, other than the folks sitting around here, have heard the term BEPS, or base erosion and profit shifting, but it is a very big topic right now in the tax world. And so back in 2012, the G20 countries, the G20 is 20 countries that participate in an alliance to focus on, you know, global economic issues. There's this perception, a very big perception in the world right now that there is tax avoidance taking place by multinationals, and so the G20 countries got together and said, you know, we got to put our heads together instead of trying to fight this, you know, one-off. Why don't we all band together and figure out how can we address these issues that we perceive are happening on a global basis? And so the G20 went to the OECD, and the OECD is a forum or a group that does research and analysis for major organizations like the G20, and they come up with guidance and they provide it to the rest of the world. And they asked the OECD to embark on a project to figure out, okay, you know, with all this, you know, potential tax avoidance, this profit shifting, you know, moving of IP, and do we have substance, et cetera, can we come up with a more standardized global set of rules that companies can adopt and then put everybody on an even playing field? And so the OECD took on this project, and they came up with this BEPS. What they did is they looked at the issues and they decided, okay, you know, globally there is a lot of mismatch going on. There's a lot of potential for tax minimization planning that, you know, wasn't necessarily intended. And you know, the rules that are in place or were in place, you know, were established long before this digital economy. You know, that today you know, things can happen over the internet that nobody ever dreamed of 50 years ago. And so what that allows companies to do is to really change the way they're doing business and do it potentially in a very tax efficient manner. And so the OECD, you know, decided, okay, we need to help the world upgrade the tax system. And so they embarked on this BEPS project, and they came up with 15 action items that are focused around 3 main topics. The first one is coherence. And so coherence, they want different tax systems to be somewhat consistent, to be integrated. They want them to talk together. There was talk about hybrid entities a little while ago. They want to make sure that countries are dealing with hybrid entities in the same fashion. There's substance, and substance was the next topic they wanted to address. They wanted to make sure that this transfer pricing concept, this concept that I talked about from an economic perspective, where one related party is paying another related party in a different jurisdiction for services or products. They wanted to make sure that transfer pricing was appropriate and it was very transparent, that everybody had a good, clear picture of what was taking place between these related parties so they can make sure the economics are correct. And then finally, they wanted to focus on transparency and also making sure the governments of every country are talking together and working together well. And so they came up with these 15 action items, and they've been working on these items, and they've been producing these guidelines that not only the G20 and the countries that participate in the OECD, but the organized world is now starting to adopt a lot of these guidelines that the OECD has produced. In fact, over 60 countries have now updated their tax rules to incorporate a lot of the guidelines the OECD has produced. So it's a great process from a governmental perspective. They're achieving a lot of these goals, et cetera. But it's also somewhat uncoordinated. You've got 60 different countries implementing some parts of different rules and stuff like that. And so it's very much a work in process, but it's a significant thing that companies are wrestling with today. I'll talk probably about that later.
Okay. Just one thing that I think might help the non-accountants in the audience would be, I've heard each of you mention transfer pricing several times. What do you mean by transfer pricing? Why do we care? How does that affect my taxes?
I'll take that.
Is there a nice simple example?
Yeah, okay, so transfer pricing deals with the economics of transactions between related parties. So a lot of times you'll have a company in one jurisdiction is having business with a counterparty and a related party in another jurisdiction. And so jurisdiction A wants to make sure that the price that the company in jurisdiction B is paying to jurisdiction A is correct, so they have the right amount of profit showing up in jurisdiction A, so they can tax that profit. And so transfer pricing addresses that transaction between jurisdiction 1 and jurisdiction 2 to make sure it's the right price, to make sure the right profit and the right expense are showing up in the right jurisdiction.
Okay, thanks
Sure.
for that. And Dave, how do you think these measures, these BEPS type measures, are going to affect U.S. multinational companies?
Well, they already are. So, there's a lot of different moving parts to BEPS, but what's been prevalent, since this initiative started, was that when we first started hearing about BEPS, a lot of my clients in Portland, they're hearing, okay, there's this BEPS thing going on. What is that? Do we really need to worry about it? We hear about all kinds of different proposed tax legislation coming along, and 9 times out of 10 it's just a lot of talk. And so at first people were just kind of going, let's just kind of wait and see. But it really started to evolve, and it really started to get momentum behind it. And then so companies are going, wow, this BEPS thing is real, and there's a lot of things that we probably ought to take a look at. So a lot of my clients in Portland said, okay, let's do an analysis. If these BEPS rules do come to fruition, if there is going to be a whole lot more transparency, if there's going to be some different, potentially different ways that tax authorities will attack transfer pricing, for instance, and it's not always, this morphing from economics now to what we call substance of, substance and value creation. If this comes about, do we have some hotspots? So there's some areas of concern that we have. And so a lot of companies did this analysis, and the C-suite was very interested, and the boards of directors were very interested. It's like, do we have hotspots? If this happens, if everybody has a very clear picture of these transactions that are going on, there tax risks that we need to address? And to the extent that companies did, and a lot of companies go, "No, we're good. We're very transparent with what we're doing, and we think it's arm's length, and there's really nothing that a tax authority could do." Then there was no issue. But some companies are going, "Okay, we do have structures that potentially use a double Irish or a structure that has a tax haven involved." And even though the economics worked out, especially under the old sort of transfer pricing perspective, that if your economics are correct in each country, then you shouldn't be able to attack profits just because it's in a no tax jurisdiction. But now that that's changing, the companies are going, "Okay, maybe we ought to morph our structure. Maybe we ought to do something, today, so that once this stuff does all come out into the public, we're not going to have any issues." And so, things that companies have been looking at is like, okay, if we've got intangible property in a jurisdiction, maybe it has a low rate or it's a tax haven jurisdiction. We've got intangible property there. Should we either put more substance into that jurisdiction, put people into that location that are creating the intangible property and making decisions on corporate matters, or alternatively, should we take that intangible property and onshore it, meaning let's move that intangible property to a location that does have a lot of substance, that does have a lot of people doing business and stuff like that, so that the tax authorities, once this new thinking under BEPS comes into play, won't have the ability to attack that and say that was an unfair or an unjust payment to a related party. And so that planning has taken place. In addition to that, there's a whole bunch of, under the transparency rules, a whole bunch of new reporting that's about to kick off. And specifically with respect to transfer pricing, there's some new global requirements that haven't been in place in the past that are now going to be required of each company that's doing operations in more than one jurisdiction on a global basis. And so there's what they call the master file, local file approach. And so this is going to revamp a company's transfer pricing documentation. And it's, in doing this sort of economic analysis for a company, it's a lot of work. And to re-engineer the process, to put together these massive reports that you're handing to tax authorities to show that your economics are correct with these related party transactions, to re-engineer that, it's going to take a lot of work. And so companies are going, really? We've got to totally re-engineer how we do this? And they're going to have to. And so this master file, local file sort of approach is saying, okay, in the master file, we're going to have a bunch of documentation that shows what are we doing globally? What's our business strategy? What does our global structure look like? And it's just going to be a file that you'll hand to every foreign jurisdiction that requests your transfer pricing documentation. So you're going to have this one master file. Then you're going to have a local file that actually addresses the transactions that are taking place with the local subsidiary and related parties around the world. And so you're going to have this more tailored set of information that will go to the local authorities. And so there's this basically this new re-engineering of transfer pricing documentation. So companies are, a little frustrated that it's going to be a lot more. It's going to cost a lot more money. They pay firms like Ernst & Young an awful lot of money to do this type of analysis, and so they're looking at it and thinking, okay, that's more money. It's expensive, but these are rules that are being passed by all the jurisdictions in which they operate, so there's no way around it. The other thing that's happening is there's something called the country-by-country reporting. And so this is in addition to your transfer pricing. What it's going to do is give each tax jurisdiction a snapshot of what you have going on globally. So you're going to have to list each of your entities, show whether your revenue is being generated by sales to third parties or if it's being generated by related parties. It's going to show your tax rate in each jurisdiction these entities are operating in. It's going to show head count. It's going to, getting at the substance discussion. And so it's going to have all of this information. So a tax authority is going to be able to quickly take a look at that information and decide, okay, looks like, you've got substance where this royalty payment's going, so this kind of makes sense. Or maybe you've got a hot spot like we were talking about. And then if that's the case, then, I think multinational companies are going to get concerned about their tax posture. So this C-by-C reporting has been, the final regulations were approved by the Internal Revenue Service in June of 2016. And so it's going to be applicable tax periods begin after June 30th, 2016. So if you're a calendar year taxpayer, so January 1, 2017, so 2017 is going to be the first year you're going to have to provide this information. What's frustrating, like I said earlier, is that, different countries are implementing these different rules at a different pace. And so the OECD had recommended that you get the C by C or country by country reporting in place as of January 1, 2016. And if we're not really doing it till January 1, 2017, or sometime between June 30th, 2016 and January 1, 2017, there's going to be this mismatch in timing. And so a company may have to produce 2 sets of documentation. So they're going to pay a firm like Ernst & Young a whole lot more money to help them produce this information. And it's a form that'll be included or filed at the same time as your tax return. I assume it's going to be included in your tax return. And it's a whole lot more work than multinationals have had to undergo in the past. So yeah, these actions being taken by the OECD, the BEPS rules, are certainly impacting U.S. multinationals.
Okay.
Can I
Yeah.
add something? So Dave mentioned the onshoring of IP or moving more material operations to the tax havens where the IP is. I think that's one possible, maybe unintended consequence of the tightening of all these rules, because what the BEPS is doing is trying to get some uniformity in requiring firms to recognize income where the economic activity happens or where the value is created. And with these the IP, in sort of a non-tax scenario, we're seeing other trends, well, partly tax, partly non-tax. We're seeing other trends where, first of all, the U.S. used to offer the best R&D tax incentives for firms to conduct R&D within the U.S. When they enacted the R&D credit, I think in the 70s, it was the only country that had that. But other countries have been improving those incentives, so now we're ranked like 27th. At the same time, to gain membership to the World Trade Organization's, countries had to meet standards for intellectual property rights, and there were different deadlines if you were developed versus developing versus least developed countries. So we're seeing a big improvement in intellectual property rights in other countries, and that is making U.S. firms more comfortable and making it more profitable for U.S. firms to move their R&D activity overseas. And those are jobs we really want to have in the U.S. because they're high-paying, highly skilled jobs. But given that, if they want those tax advantages, they have to have the economic activity there. There's R&D tax credits there. There's intellectual property rights there. We could start seeing more shifting of those R&D positions overseas.
Great. So we already have 2 questions which tie into a question we were going to address. So given the results of last night's election, I'll read it off one of the cards. With Trump being the president next year, how's the corporate tax rate going to change? What does a Donald Trump tax reform look like? Causes and effects. So what's going to happen in the next 4 years?
So I'll start on that. I don't know what's going to happen, but I did look up the Trump tax plan. This is just what I read on the Trump-Pence website, and it's interesting in regards to. I'm going to focus on the corporate tax implications here, and this is proposals. What actually gets passed or what's plausible, I don't know. It's interesting for individuals. He's going to lower tax rates. He's going to simplify. Right now we have 7 tax brackets. He's going to simplify that down to 3. These are the proposals. Who knows what the reality is going to be? The standard deduction, which is about $12,000 for a married couple, he's going to increase that to $30,000. So this on the individual level, some pretty significant tax cuts. For corporations, the plan that he articulated is kind of interesting. He talked about lowering the corporate tax rate from 35%. We talked earlier about how that's relatively high. He's going to lower that to 15%. But what's interesting about the plan is he actually is going to eliminate most corporate expenditures. So I think it's going to be closer to a gross receipts tax. He says he's going to he's going to allow companies to have expenditures for research and development to try to incentivize research and development. So we're going to have a lower tax rate. But I think the plan is then to have a broader tax base, which is, I thought, is an interesting proposal. The other thing he proposed that's interesting is that he would have an immediate deemed repatriation of these corporate profits that are being held overseas and tax them at a 10% rate, which would be interesting. That would raise a lot of tax revenue very quickly because, as we talked about, there's a lot of this money overseas. Long run, I don't know what the implications of that would be. This looks a little bit like a tax holiday. I don't know if the companies under this rule that he's thinking about would have discretion on repatriating at the 10% or whether it would be a deemed tax where they are just immediately taxed at 10%. I don't know. So some interesting stuff out, interesting proposals. We'll see what happens.
So rough numbers, how much money is parked overseas that would potentially come home?
2 trillion, I think, is the most recent figure. Yeah.
So $2 trillion times 10% would be a lot of,
lot of
200
billions.
billion, I think, right?
Yeah.
So that would be a pretty big, and our current budget is,
Yeah, it's interesting, and I mean, and I think the prospects for some of this stuff actually happening are reasonable because we do have now Congress and the president from the same party. So, I mean, it's kind of exciting to see we may have some tax reform.
Yeah, we actually had a repatriation rule that took place, I don't know, probably somewhere between 2004 and 2007, 2004, yeah, Section 965. And a lot of cash did come home. So, if this was put in place by Trump's administration or by Congress, then I think we would see a big infusion of cash into the U.S.
Yeah, so I think Ryan's right. We are more likely to see some corporate tax change. The last election, both candidates were proposing a lower corporate tax rate, but nothing happened because we had disagreement between Congress and the president. But now we have more agreement, we'll call it. But it might. So what he's reading is I went and read that too, his tax plan on his website. But a couple hours before this started, I read a Wall Street Journal article that says that the House is already writing a bill. They want to push tax reform in the first 100 days, but what they described wasn't anything on what Ryan just described. It was more interborder taxation and taxing imports but not exports. So it could be a moving target.
Yeah, I
We'll
mean
see.
that's interesting. That's I think the bill that Paul Ryan, as the Speaker of the House, has pushed forward. I mean, there's some very interesting concepts of not taxing exports but taxing imports. And so what that's going to have the effect of is manufacturing in the U.S. You're not going to want to manufacture overseas and bring it into the U.S. because it's going to be taxed if that happens. If you're manufacturing in the U.S., you'll be taxed. But if you export, your exports are not going to be taxed. So it's going to have presumably a pretty big effect of bringing jobs home. So interesting concept on that. And then the differences between what Trump, his campaign tax platform had in it versus what the Republican platform had in it. I think one of the main differences is Trump was looking at a 15% corporate tax, whereas the Republican platform has a 20% corporate tax. And then Trump's platform was silent on whether we would go to what we call a territorial tax system, where we wouldn't tax profits and activities taking place outside the U.S., whereas the Republican platform does address the territorial nature of their tax plan. So interesting, yeah. It'll be interesting to see what happens, but I think it's going to happen. I mean, not only do we have Republicans that have a majority in the House, have a majority in the Senate, and now we're going to have a Republican president. We also have Democrats who want to see tax reform take place. So there's just momentum everywhere for tax reform to take place. So it seems inevitable. And it seems like it's going to happen fairly quick. Paul Ryan, the Speaker of the House, said it's his most important thing he's going to do. So it's all fair enough to do it.
any other comments on what's in store for us, tax-wise? Okay. So moving more locally, so we had a ballot measure in Oregon, Measure 97, which received a great deal of attention, and I would say Tuesday's vote failed fairly decisively. What are some of the alternatives, though, for raising state revenue from corporations that might exist in the wake of Measure 97 not making it through. What is that? What are our options for funding our schools with more money, funding the university?
Well, it's probably not going to be a sales tax. That's fallen flat many times in this state. Did you want to take that one, Ryan, or I can roll with it?
Yeah, I mean, I don't know what's politically sort of plausible. I mean, it doesn't, obviously, that went down pretty decisively. So that was a gross receipts tax, sales tax. I looked up a little bit of the background on it. There's like 5 other states that have that exact kind of tax. Mm-hmm. The rate that was proposed was pretty high relative to those other states. So I don't know. It was interesting to read about the proponents and the opponents to it and everything. But I don't know. Would a franchise or capital tax be more palatable?
It could be. I mean, it's more. I think the biggest issue, at least from my perspective, is that Oregon doesn't have a stable source of revenue, right? So we have an income tax, and that ebbs and flows with the economy, and so it's hard for our state to put together budgets when they're not exactly sure how much revenue is going to be coming in. So how do you put in place a more stable source of revenue? Most states have a sales tax. That doesn't fly in Oregon. So we got to figure out how can we, figure out something that's more stable. And so, Measure 97, I mean, it certainly would have provided a stable source of revenue. It's something people can count on. You're looking at sales versus profits, whether the economy's doing well or not. Sales don't change nearly as much as profits do. And so it would have accomplished that goal. The problem with 97, though, is flawed in many ways. I mean, it's taxing certain taxpayers and not others. I mean, Fred Meyer would be taxed, but Albertsons and Safeway wouldn't be. I mean, that just doesn't make sense just because of their corporate form. Measure 97, another fatal flaw, from my perspective at least, is that, it was earmarked for education, healthcare, and the elderly, yet it was just going into the general fund. It could be used by anything by the legislature. There was nothing that said they had to spend it on those areas. And so, I think if the proponents of 97 were to sit back and look, okay, why did this fail, and come up with a better plan, and I think a better plan would include reducing the rate. I mean, 2.5%, you compare that to our neighbor, Washington, they're 0.5%, is, quite a bit higher, right? And so I think if they were to consider things like that, maybe that would be something that would be more palatable for our economy, but it's hard to say.
I think one of the problems with that measure was that Oregon's a very liberal state, and so I think as a result of that, we have a very progressive income tax system. And so the income tax that we have is progressive, meaning that higher income individuals will pay a higher proportion of their income than lower income individuals. A sales tax is considered to be very regressive because you're going to be paying sales taxes on a lot of necessities, and so lower income individuals are going to end up paying a higher proportion of their income in the sales tax, so that would make it very regressive. Our tax system is actually one of the most progressive in the country, although we do have a lot of fees, which would take away some of that progressiveness of the tax system. This this tax bill was kind of pitched as, well, we're only going to tax the big corporations that have more than 25 million in sales, which kind of makes it sound like it's going to be more progressive, except that those corporations are going to pass that, or will likely pass a lot of that on to consumers. And so then you get something that works a lot like a sales tax, and so we're back to that regressive nature of the tax again. So I think from that perspective, that turned a lot of people away. And then they mentioned, the size of it. I read a couple projections. One was that it would increase state tax revenues by 25%, another by 33%. I mean, that's massive for a single tax measure. So I think just because of its size, it didn't have much of a chance. So if, in terms of alternatives, something that would kind of fit more with the nature of the tax system in the U.S. that's not quite so regressive. I think something like that would work. Even though, as Dave said, an income tax isn't quite as stable as a sales tax, but you still have to get the votes. So.
I think one thing that's hard to appreciate, and that I didn't really appreciate until I started working, is how many companies lose money in a given year, right? Especially when the economy is bad. It's sort of, I had this conception that if you have a company that continues to run, you should make money every year, but that's just not true, right? I read that 70% of the corporations in Oregon are paying the minimum tax, which is like a 0.1% of your gross receipts. They're not paying the 6% income tax, and so that's where this volatility comes from in the tax receipts, and I think that's why there's this desire to do something different. But obviously, this was a big flop, so it's interesting.
Okay, so we have a lot of good questions here. So one of my favorites here, and they're all my favorites. They're all my favorites, but. So one of them is there any evidence on which types of taxes, sales, VAT, corporate profit, dividend, individual income, have the greatest impact on economic development? And then I'd like to add on kind of another question from another card, which says, on top of that, tell me your favorite tax rate. Okay. Okay, that's what I want to know. What's your favorite tax rate?
0.
Okay.
So, first, can you repeat the first question again?
Yes, I'll repeat the question. So, which types of taxes? So, sales taxes, VAT, value-added taxes, corporate profit taxes, dividend taxes, individual income taxes have the greatest impact, both positive or negative, on economic development. What do we know about that?
Wow.
What do you? Because I don't know anything.
That's a tough question. I think, certainly the perception is a high corporate income tax rate has a negative impact on your economics. So, I think just from a planning perspective, I've helped a lot of companies, not so much internationally, but more deciding, okay, where should we locate our headquarters? Which state makes more sense? Which has the highest tax burden? And the first thing, any C-suite, CFO or CEO, COO, or board of directors will look at is what's the income tax rate in that state, and that always has major influence on whether they're going to consider locating in a state. Of course, incentives, a lot of times states will come up with incentives to try and help them relocate and stuff like that, but that's always secondary. It's always what's the income tax rate. So I know that's important. We don't have a VAT in the U.S. A lot of other jurisdictions do. It doesn't seem to me like a VAT really slows down commerce. I think VAT is hard to administer. I'm not a fan of it. It's somewhat like a sales tax where there's a lot, with a sales tax, they've done studies, and the amount of administration that goes into, a sales tax is like 25% of the tax you're bringing in goes into the administration of the tax. And so it's a frustratingly expensive tax. And I think a VAT is similar to that. So, that probably impacts your economy in a different way. But I think from a perception perspective, I've always looked at income tax rates.
I think about this maybe the opposite of the way the question was stated. So maybe if you lower a tax, which tax could you lower that would have the biggest effect on increase on economic development versus which, if you raise, would increase economic development. And the thing about any corporate tax, or two things about any corporate tax that you levy. First of all, corporations are subject to what we call double taxation. So the corporation itself will pay tax on its income, and then when it distributes its earnings to shareholders, it'll be taxed again as a dividend. So when you increase corporate taxes, you're sort of increasing that second layer of tax. The other thing about corporate income taxes is that, again, you want to look at the incidence of a tax. And anytime you levy a tax on a corporation, it's ultimately going to be borne by an individual because either in the way of raising prices, so consumers end up paying that tax, or decreasing what the individual investors get in terms of the earnings from that tax. So I would say if you want to spur development, improve the economy, lowering corporate taxes would have the biggest effect, because then you get more growth, you get more jobs, things like that. If you want to raise taxes, then where could you raise taxes and have the least negative effect on the economy? This is not something I've studied, and I can't think of any studies that I've read, but I mean, I would think that raising taxes on higher income individuals would have a less negative effect than on low income individuals.
Yeah, I mean, that question's way over my pay grade. For sure. You would think it would corporate tax, right? Because corporations in a position to deploy investments quickly, and that's going to have the biggest dramatic effect, certainly in the short run, no question. So.
Okay. Great. So the next question that, so these are kind of an interesting question about lobbying. So how much money would you guess, and I've never seen numbers, is spent lobbying Congress on tax rates? So Dave probably is in the best position to appreciate this.
You know, I mean, we have a lobby group of our own, you know, the Washington Council and Ernst & Young, and they make a lot of money. You know, I think as we all know, there's a lot of lobbyists back in D.C. and they're getting paid a lot of money. It's not just back in D.C. I've got buddies in Portland that's what they do. They're lobbyists for not just tax issues, but governmental issues. But they take on tax issues all the time. And it's lucrative. People are willing to pay big dollars to have the right people making the right calls and setting up the right meetings. So.
Yeah, I know I've read papers on lobbying, and I think I have a paper that has some lobbying data, but I can't think of what the average amount. If I could look it up, I could find it, but I can't think of what it is. But there is a significant amount that's spent on lobbying, and sometimes it pays off pretty well for corporations. Dave mentioned the 2004 Tax Act a little bit ago, and there is a study that looks at the payoff to firms that lobbied for that tax act. So there was this Homeland Investment Coalition that lobbied to get this one-time reduction in the U.S. tax on repatriations, and it was lowered from 35% to 5.25%. And these companies brought back billions under that act. And I think Ryan might help me remember this. I think the payoff was like 18,000% or something, or 40,000%. It was a
Money well
pretty
spent.
big payoff.
Yeah.
Money well spent.
So the lobbyists actually are cheap.
Yeah, if you look at it like that.
Okay, so what does tax complexity actually mean? And internationally, does tax complexity necessarily cost more resources, time, money, and effort? And how could you measure tax complexity if you were trying to do research?
It's how complicated is your tax system? You look at the U.S. tax system, the code and regs. I mean, you're talking a stack of books that's this tall and just rice paper is very thin. So it's incredibly complicated. I mean, I've been doing it my whole career, and I think I'm conversant in maybe a third of it. Right? There's a state tax. There's all kinds of taxes I've never even heard of that are in the code and regs. So the complex nature of the rules that are in place in the U.S. it's insane. And then you multiply that by the number of countries around the world. That's tax complexity for sure. So how do you measure it? It's tough. I think if you can get to the postcard approach, where you have an individual who understands how to do his tax return and puts it on a postcard, I think that's reducing tax complexity. That's not as bad, but we're not there. And I think a lot of folks are hoping that some sort of tax reform will send us in that direction.
I think too, it's not the same question, but that's related to that is tax uncertainty, and I think that can potentially be more damaging than tax complexity when companies are sitting around waiting and anticipating there's going to be some change in the tax law, or they're not sure how the tax law is going to be enforced. I mean, this is one of the things that Apple has raised with the European Union, that there's sort of a lack of a rule of law there. It's that kind of uncertainty that I think can be really damaging to the global economy when everybody is sort of sitting on their hands trying to figure out what's going to happen. So it's not complexity, but it's a similar problem. Yeah.
Yeah, well, in terms of measuring, tax complexity, I would have to spend some time thinking about how to measure that, but a couple things that come to mind is, we have our tax code, so if you could get a tax code for all different countries, maybe you could look at the number of pages in the code, or if there was data on the average amount that corporations or individuals spent preparing their tax returns, that would give you some idea of the different complexity across countries. As far as uncertainty, you could, there are, I think it's PwC that publishes a worldwide tax manual, so you could.
I don't think it's very good.
You don't think it's very good? Does E&Y have one? Because we'd love to see it if you do.
My corporate tax guy,
Yeah, okay. So you could dig through those and look for changes, or you might even use that for complexity as well.
Okay. So the next question, back to the election yesterday. What's your input on Trump being reluctant on releasing his tax returns? And I wouldn't really say reluctant. I would say refused. Refused.
Refuse?
They're not coming? Are they not coming out?
I don't know.
Yeah, I mean, that's an interesting situation. So, we claim $916 million in deductions or a loss. I forget how many years ago, sometime in the 90s. And, he hasn't released his tax returns, but it's everybody's assumption that he's carried that loss forward and hasn't paid much tax since, right? And so, the concept of generating a net operating loss and then carrying those losses forward to offset future profits that makes sense to me. I mean, that makes a ton of sense. A company shouldn't pay, or an individual shouldn't pay tax if they haven't generated profits on an overall basis. And if you have losses in one year and you carry those losses forward until the point that you're profitable at some point, and then you start paying tax, that seems economically justifiable. The question I have, though, and I think this was brought up, I'm not sure where, but somewhere in the news, was how did he generate that loss? And back in the 90s, it was pretty fast and loose. There was a lot of shenanigans going on in the tax world, and there were a lot of transactions that were subsequently, listed by the services being tax shelters and being abusive, and there's been talk that potentially that's how he generated that loss. And so, if that's the case, then I think I would have an issue with it. I think most Americans would if he's, generating a fictitious loss and then using that to shelter profits and not pay tax for many years to come. Sounds like an issue.
I personally was disappointed that he didn't release them because I like to use, they're a great teaching tool, so I like to use the politicians' tax returns in my classes. I've used Obama's. I was teaching intro tax last winter when the Clintons released theirs, and I was waiting and waiting, hoping that Trump would release his, but he didn't. So we looked at the Clintons' tax return, and it wasn't that interesting because they pay 35% tax. So, but they're a useful teaching tool, so that was the reason I cared.
He let down America's youth.
Yes.
Okay, so I would like to, are there any other questions? Okay. Okay, so we want to thank you all for being here today. Any final statements? So as our students go on to be great titans of industry, what's your best tax advice in 2 sentences?
That's a question for the tax partner, not the professors, right?
Actually, and I have another one, just in under the wire. Are accounting jobs at risk due to artificial intelligence?
That's a great question. I mean, artificial intelligence, the digital economy, things are changing very quickly. And I've heard predictions that, there's going to be a lot of what we do today is going to be handled by robots, and AI. And so, is that going to get rid of the jobs that we have today? No. Is it going to change what we do? Probably. You know, I think a lot of the stuff that's going on at the IRS right now, the IRS is reducing the number of agents, but they're spending a lot more on data analytics to determine, you know, who do we audit, and, you know, where's potential hotspots, what should we be going after. And so, you know, I think the more mundane, you know, tax compliance preparation jobs could, you know, at some point shrink, and as far as opportunity for humans to do them. But, you know, I think tax planning, I think, you know, there's always going to be, if you're an individual, you're not going to want to go to a machine and say, what's the best way to do this? You're going to want to be able to talk to somebody, discuss alternatives. You're going to want somebody who understands how to make things happen, you know, has relationships if you've got a tough situation, that you can talk to tax authorities, that sort of thing. So there's always going to be opportunities in this field, but I think the opportunities, you know, are going to change, definitely.
Stay in school and get your master's degree so you can do that kind of high-level
exactly
thinking
right.
that Dave wants you to do. So.
Okay, and then any other questions? Okay, well, thank you all for your attention. And thanks to our panel. Yes.